Hello, and welcome to another episode of the Future of CRE Sustainability. I'm your host, Sean Swentek. Today, I'm speaking with Eric Meyer, partner at Activate Capital. Activate is an investor in our company, Omnidian, and I'm really excited to welcome Eric to the show today. Eric, thank you for joining me.
Thanks for having me, Sean. Appreciate it.
Activate is an organization that definitely leans into sustainable type investments in your portfolio. What drew you to Activate originally and sort of that particular niche of venture capital?
Yeah, I can kind of give the intro to Activate and what we're up to, and maybe it's better told through kind of the story of my background. So I'll try not to be too long-winded here, Sean, to cut me off. But I was chemistry training by background. I was doing a lot of kind of green chemistry, fundamental research as an undergrad. I went into the world of business, joined management consulting for 3 years, and then went to the public equity side for 3 years. And kind of after those two experiences, really wanted to get back to kind of focusing on kind of the energy transition, climate change. And so I decided to go to business school and use those 2 years to find a fund that was really kind of focused on, what we're talking about around sustainability and energy transition. And so this was back in 2017, and there was a new wave of funds that were popping up at this time, including where I landed Activate Capital. And so I was lucky enough actually to intern with Activate in the summer of 2018, got to work on an investment around Nozomi Networks, which is actually a cybersecurity platform for critical infrastructure.
Mm-hmm.
And so I was really attracted to Activate because we have a kind of, I think, a unique lens of our investing style. It's not just kind of decarbonization like a lot of, kind of other climate funds. We're really technology investors for the built world.
Mm-hmm.
And we're growth equity investors. So we're not early stage investors. We're kind of investing in businesses that real product market fit, are scaling, have real revenue and real traction. So for me personally, coming from McKinsey, coming from the public equity world, like it was important for me to find and kind of work with companies that are truly scaling. So, with Omnidian, being on the board and working with Mark and team for the past 5 years, it's been great because it's been able to kind of, be more than just a piece of paper for, Mark to take to the bank, but rather actually try and add, expertise and help Mark in the business grow. And so that's been truly unique and a great experience. And so I think just, with Activate, you can think of us, we're a $500 million fund. We typically lead rounds. We're kind of in that late stage venture portion of the stack and really investing around these kind of macro disruptive vectors that we like to point to, which is, the one most obvious, especially for probably listeners of this show, is climate change.
Yep.
And then the second is, there's other disruptive vectors around, what we're seeing in our political environment right now. There's supply chains are rapidly changing, the global world order, the kind of decoupling away from China. And so these things all provide opportunities for us. And so if you look at our website and where we invest, you won't just see decarbonization investments, but you'll see energy transition, you'll see reindustrialization, you'll see kind of supply chains investments, you see a lot of, more recently AI infrastructure. So that gives you a sense of kind of what we're up to.
Yeah, you guys have your hands on a lot of the key things moving the markets right now, so that's exciting. What specific things do you look for when you're making your investment decisions there?
Yeah, I think ultimately, the tricky thing about where we play is, we're entering into that Series B and C, which can be anywhere from kind of call it 100 million of equity to up to $1 billion often. And so when we're underwriting a business, our cost of capital is typically kind of 3x plus, depending on the risk for that business.
Mm-hmm.
And so just to give an example, like if the median equity value that we come into is kind of call it $300 million pre-money, that means to kind of make our return and our hurdle rate, we need to underwrite to $1 billion exit.
Yeah.
That's a big number.
Mm-hmm.
And if you look at like the kind of climate space or climate adjacent space, like there aren't that many $1 billion exits. Like it's a category that has, there's obviously Tesla that people point to, but it's hard. And so, we're ultimately making a bet that there's, trillions of dollars, and McKinsey points to this number, there's, $5 trillion per year that's needed to kind of come into these renewable energy assets. But these are, we're trying to back, the strategy for us is to back category defining businesses that can truly be kind of $1 billion outcomes. And so that's hard. Those are hard to find. And there's a lot of false starts and head fakes. And so we spend probably most of our time trying to answer two things. One is around why now? Like why is a technology or a team best positioned for inflection? things like carbon market or hydrogen or other, categories we've looked at, we decided to pass on just because we haven't been able to get comfortable with the true kind of fundamental drivers driving those businesses. And then the second is around product market fit, which is kind of a close coupling of that. Once we have conviction that there is a why now, and we've made an investment recently in a space economy play. Like we got really comfortable that space economy, largely what SpaceX did to launch, would proliferate with kind of space infrastructure, satellites in lower Earth orbital. And so, we wanted to play the macro theme. And then the question is like, well, what is the right attach point for us? What is the right company? Where do you have, the best kind of founder market fit, the best team, the best product market fit? And we spent a lot of time assessing things around product market fit. Do they have the right customers? Is there customer concentration risk? Do they have contracted kind of cash flows? Is there visibility into long-term revenue? And then, trying to supplement that with, business quality around, if I just simplify team, TAM, moat, like, are they building a durable business, which is moat? Do they have the right team in place? And is, the TAM big enough to absorb the capital that we would be providing to the company?
As someone who's invested in the future of energy, and if we look at it from that perspective alone, what are the biggest trends you're seeing in clean tech specifically, and maybe some trends that are possibly a little overlooked right now as it relates to that?
Yeah, I think, this is probably one of the most exciting times, at least in my kind of, shorter career. Our managing partners have been doing this for, 20, 30 years. But when I first started doing this, it was really this kind of idea of the utility death spiral. The idea was we moved to more decentralized generation, and the utility would lose its ratepayers, and kind of what would be the purpose of the utility in that world. And I think there was that environment made it almost toxic. If you think about corporate real estate or residential and folks building distributed generation, well, the utility is often hostile to that. Or things like energy efficiency programs, or things like demand response, which we can get into. And so the utility has always been very hostile to that. What's changed, and what everyone's talking about, is the AI buzz. And so you're finally seeing a time, or since the last decade, where we're back into an era of load growth. And load growth solves a lot of things. I was talking to utility yesterday. It's in the middle of the country. In their territory, they most recently printed 4% load growth. And 4% may not seem like a big number, but for this industry, it was flat for a decade. 4% is a lot. And so I do think that the trend back into load growth heals a lot of wounds, allows for innovation, allows the utility to say, oh man, we need all solutions, not just kind of trying to fight over their rate base before. And so I do think that brings challenges and opportunities for folks like myself that are in venture capital, and for companies where it's like an all solutions on deck type environment that we're living in. And so I do think, as we try and match that load growth with new generation, which is important to, certainly the current administration, as well as, it's pretty bipartisan at this point, to have kind of energy security and energy abundance. If you look at the backlog for different types of generation assets, like, NextEra famously came out with recently in their earnings report that to get a new natural gas generator and a natural gas turbine, like the backlog is 5+ years at this point.
Mm-hmm.
And so no matter what politics you want to believe in, like it's very, challenging to get new generation onboarded. And if you look at solar and wind, which is kind of closer to 1.5 or 2 years, that's the fastest thing speed power wise. But if you look at the interconnection queue, like there is a massive backlog to try and get these solar projects online, these wind projects online, these storage projects online. And so there is a little bit of a bottleneck right now. And so for utilities to continue supporting the industry and reindustrialization and all the things that we want to do as a country, like something's got to give. And so there are policy things that I think, folks are trying to figure out around solving some of these interconnect challenges. But I think the big thing that we as an industry are looking to do is like, how can we, I think the big word that I'm using now is, a firming resource. Like solar and wind inherently are not a firm resource. They're intermittent generation. And so, can we use storage? And you're starting to see a huge proliferation of storage in Texas, which is a deregulated market, but use that to firm up some of these intermittent resources. And so I think the big push of the last decade has been, get as much solar on the grid, as much wind on the grid. And we'll continue to see solar at kind of probably a steady state, you continue to get put on the grid. But the next phase here is trying to make solar more intelligent, which is, through storage either behind the meter, commercial buildings, residential buildings, or in front of the meter as utilities look to build portfolios. They need to firm up that generation.
So you mentioned this, obviously, over the last 20, 30 years, energy sourcing and types of energy have changed dramatically. But to meet this load growth, are you expecting that we'll continue to see the same paths? I know you mentioned solar and wind being the fastest paths to meeting some of that demand. What do you think about when it's like utility versus distributed generation and how we meet that? Because obviously interconnection is a little different between those two. What are your thoughts just going forward on how we meet this huge demand with data centers and AI and everything else?
Yeah, I mean, I think a little bit is like kind of what I said before of like, it's an all the above if you're doing SAT, an all the above type, response that we need. So I think there's like a couple things. One is, utilities are starting to embrace distributed generation more and more. So there's some utilities that are doing this, distributed capacity procurement plans. They're actually like rate basing billions of dollars of distributed infrastructure because they know to keep up with the demands of their customers, of their ratepayers, they can't cite front of the meter, utility scale, whether it's solar or or kind of traditional fossil, quick enough. And so they're having to actually rely on more distributed type procurement solutions, which can be stood up a lot quicker, even in kind of the 1.5 to 2 years I was mentioning for solar and wind utility scale. And so we'll see how much that takes off, but Excel in Minnesota, Southern Company, there's folks that are working with a company called Spark Fund that are trying to stand up these types of programs and make kind of distributed generation truly a part of the solution. I do think on, distributed generation also helps with a lot of the transmission bottlenecks. It's localized generation, so it solves a lot of congestion issues. So I think that's a key win. I think if you look to kind of what we're seeing from a regulatory, certainly a lot of the buzz was around net metering, 3.0 in California. So if you do have, or you're seeing Australia as well, like when you have these states where you have kind of saturation of solar, I do think there's, I do think that the industry moving towards firming that up, going back to the last topic, firming that up with some sort of storage is important. And so I do think there'll be a trend, and we're seeing in California with the attach rate of storage now close to 80-90% with new solar systems. I think you'll see that trend continue. When it's California, you're seeing it. I think you'll start to see it in Texas and Florida as well. So I think that will be a big trend to continue forward. But I think like to keep up with load growth, utilities and regulators will need to continue to embrace distributed generation. We can talk about transmission if that's interesting, but that's one of the areas that I've been kind of acutely focused on, just because our transmission network, it's so hard to build transmission. It's so important to our energy system. And, a lot of studies show that we're going to need 2 to 3x the size of our grid to bring out a lot of these new resources.
Big challenge ahead. Residential and utility have been like the big drivers of solar growth in the US for some time. Commercial and even community, CC and I, have started to play catch up a little bit. What do you think is driving the uptake there beyond just environmental or ESG type factors?
Yeah, it's probably the obvious things to point to. I think there's the energy savings. Like, at the end of the day, corporate real estate owners are rational. So certainly some of them may have like ESG commitments. At the end of the day, people are doing this to save money, to earn money, to put money back in people's pockets. Maybe a good example is like even in the mush market, the municipal universities, schools, hospitals. One of our portfolio companies, Generate Capital, is one of the leaders in financing distributed energy infrastructure. And so they like talk about one of their major customers, which is the Hillsborough schools in Florida. I think it's maybe the 6th largest school district by enrolled students in the country. And they have a massive energy efficiency and solar program with the school district. And so what's so cool about this case study is like school districts do not have a lot of money. They're looking to try and prioritize spending their money on teachers and schools and textbooks and new equipment. And so by coming in and providing pretty basic solutions around energy efficiency, whether that's LED retrofits, billion envelopes, kind of very basic things. And pairing that with solar, like you can save these school districts, millions of dollars and redirect that budget towards productive uses. And so I think, whether it's the mush market, whether it's corporate real estate, like the powerful thing that generators are unlocking is sometimes capital is a barrier, but these technologies, these solutions are in the money.
Yep.
And you can find a cost of capital that can unlock them. So, some of the challenges have been like, well, how do we get that capital? How do we, have the right kind of principal agent, solving that if it's the tenant or the landowner that actually benefits. So there's, credit worthiness that's can be tricky as well. But, getting past and solving some of those things, at the end of the day, these solutions are in the money. And so capital, if you can aggregate capital in a way, capital will flow to where there are returns. And so I think that, the generate example is something I always like to point to because it's so powerful, showing that, these things can be good and actually have a social benefit as well.
Yeah. And I mean, we're seeing utility energy rates continue to rise year over year. So for your average commercial real estate owner operator, it's almost a no-brainer at this point to look at these alternative energy investments. We talked about resi and utility scale solar, and especially the battery storage backing that up to firm it. What are you predicting in the CC&I space for those adjacent technologies, battery storage, and even like EV charging? Do you think we'll start to see those catch up as well to the other sectors?
Yeah, it's interesting. Like one of our first investments at Activate was a company called STEM, which at the time was a leader in, building, financing C&I batteries. And it was really around this concept of demand charge management, which was using the battery to kind of peak shave during that period of peak demand for the corporate real estate owner. And so they had a really interesting business model. There were some programs in California that allowed that business model to work. They expanded into areas like Ontario, where there were some kind of market mechanisms where there was high demand charge. But what's interesting is that business, they ended up moving more into front of the meter because the market was just so much bigger. Challenge with front of the meter and utility scale is it's much more commoditized. There's more kind of optimizers, these battery optimizers, so it's much harder to make a margin. And so if you just look at like the BNEF data around resi versus C&I versus utility in terms of battery or storage deployments, like C&I has been a pretty big laggard. And so, I think, there's just a little bit of a risk aversion in that space. I think the resiliency, like if you look at kind of what's driving a lot of residential, it's certainly kind of the NEM 3.0 stuff that we talked about, but it's also the resiliency piece. Like, people want backup power. The grid in California specifically, there's been more public safety shutoffs. And so, people want, just like they want a generator historically, like, these lithium ion batteries are pretty effective at being backup resources. Yeah, I think that's less so in kind of like core urban environments where you have, pretty good access to power. There might be kind of other backup generation. And so we just haven't seen the resiliency play be as powerful as a driver on the C&I side. And that may change. The economics will continue to get better and more supportive, certainly, as these things get cheaper. On the EV charging side, it's interesting. I think a lot of the data, at least currently, especially with EVs being adopted by kind of more premium segments. At the moment, like a lot of charging just happens at home. And so, what you're seeing is this kind of, people are this range anxiety. People want to make sure that there's charging if they're going on a long trip. And so you are seeing a lot of capital flowing into EV charging, kind of off highway or DC fast charging. We invested in a company called Volta Charging that was building level 2 charging, so not fast charging, but going after kind of core real estate pockets in front of highly trafficked areas. So think like a Whole Foods or a Walmart or a Target. And that business model has been pretty effective. But I think what like the next layer, I think what people really want is DC fast charging. People don't want to charge for 8 hours, 6 hours at a Walmart. And so I think we're now seeing interesting companies pop up that solve kind of two things. I think one is you're going to do DC fast charging. There's nothing inherently challenging about pushing more power to the vehicle, but it just requires a lot more power. So going back to the last conversation we're having around generation and power constraints, if you're a Chevron gas station in the middle of the city, you pick that location because it's highly trafficked and people, you want to use that to refuel. But when that Chevron gas station was built, it wasn't built with the idea that there would be a ton of power being delivered to that Chevron. And so if Chevron calls up PG&E or the local utility and says, hey, I need more power, that could take 5 years to upsize their transformers. And so I think, long story short, I think one thing that I'm excited about in terms of kind of solving that problem is just, using batteries, batteries paired with charging. And there's a company called Electric Era that's kind of pioneering this, or that's not pioneering, but it's kind of rolling out a solution to this and, basically lowering what the transformer size needs to be so that you can bring on DC fast charging and use the battery again to kind of optimize around intelligence.
It's exciting. You mentioned AI and, you guys invest in quite a bit of clean energy technology. These companies are often on, the bleeding or leading edge. What's your assessment look like? Like, how do you ensure that these companies will actually deliver on their promises and it's not just vaporware or, overselling what they can do? What does it look like when you're looking at these technology firms?
Yeah, so I think there's a couple of ways. There's one is like part of what we do is like investing in the core infrastructure that enables a lot of like the applications that we may use as consumers or business may use. And so, that is like a kind of enabling infrastructure play. And the companies we most recently invested in Crusoe, which is really helping kind of build data centers for Oracle and others, and actually using stranded power to enable that infrastructure as a way to lower the costs or speed to power. Going back to our conversation about interconnection. So there's kind of that bucket of what we do, and I think there's really interesting solutions and technologies that are coming on board that are enabling data centers to be more effective and just larger. On the application side of AI, I think it's like, at the end of the day, it's kind of a continuation of, I think, what technology has been doing for the last, 20 years, 20, 30 years since technology, since Silicon Valley's been around, doing technology investments and software investments. And so if you take Omnidian, for example, when we invested in Omnidian back in 2021, like the word AI wasn't as much of a buzzword, but like the idea of Omnidian to look at expected production performance and actual production performance, compare that, any anomaly then is alerted and then is sent over and actually basically create a almost an air code to say, hey, what is going on at that solar plant. And so that is a form of kind of using AI or anomaly detection. And so we've been investing in anomaly detection type businesses for quite some time. And so I think like AI is, the way that some people are using AI today is a continuation of, I think, what the industry's been doing. I just think the tools and the speed at which you can do them are increasing tremendously. And so I think like the big push that we as investors, I think, are more on like, how can we push our portfolio companies to use AI tools that are out there to be more efficient and get more operating leverage. So I think that's almost the role us as kind of board members or as investors. I think like there's just huge. It's really interesting to see how creative certain companies are getting in using AI to help make their businesses more efficient these days.
Yeah, it's either get on board or get way behind.
Totally.
What caused you to be a believer in Omnidian initially? What do you think was unique about us in the market, and what causes you to be bullish on the future of Omnidian?
Yeah, I think it may be best told in kind of like a story of like Activate and portfolio construction. And so I think like we were seeing, like our conversations, see a lot of investment at the edge, a lot of need for distributed generation and distributed generation storage being kind of a piece to the overall pie of the energy transition. And so you're seeing kind of solar coming down the cost curve. You're seeing transmission bottlenecks. And so we at Activate kind of built the collection of technology solutions at the edge. And so if I kind of step through those, it almost kind of helps paint the picture of Midian and our larger portfolio. And so we have invested in a company called Posigen, which is bringing rooftop solar systems to low to moderate income households. So it's a really powerful company, and it's really around energy independence. And so the key there is financing, going back to capital being an unlock. And so financing these $30,000 systems for LMI households is a truly powerful kind of financial product. So invested in Posigen. Next, we looked at how do you think about providing more flexibility from these distributed or edge assets. As we invested in a company called Voltus. Voltus is the leader in C&I demand response, but they also have a resi portion as well. But basically taking C&I load and, when the grid is under kind of some sort of stress, calling upon those assets and dispatching those assets and turning them off and delivering, value back to the grid. And so we have basically like proliferation of edge assets, flexibility of those edge assets. We invested in a business called Lunar Energy, which is the power electronics around home solar and storage, or C&I. And so basically the thesis there is that the future of residential or rooftop solar is residential rooftop solar and storage. And so you will have this coupling of solar and storage. And so there was an interesting kind of attach point for a new player to compete with the traditional inverters like Enphase or SolarEdge, or the traditional battery players like Tesla or Panasonic. They're bringing a whole system, to the developers. And, I think the thesis for that company too is around this dynamic load management. That if you have storage, now you can do really interesting things. If there is an outage, where do you kind of route that power to? Do you, keep your refrigerator on backup? Do you charge your electric vehicle? So having kind of home intelligence is super important. And so then kind of, I think bringing it to a median, if you think about from portfolio construction perspective, it's like you have all of this, activity happening at the edge. I have solar panels on my roof. These are all mini power plants. And so how do you effectively manage these mini power plants? Well, the traditional way to do it, we have centralized generation, is you got a whole fleet of mechanics and technicians on site operating. And that's just not going to be cost effective when you have distributed assets. And so solar, at the end of the day, like a lot of new modern types of appliances and infrastructure, is an IoT device. And so you can take that IoT connected device, use that data, and like we were talking about before, apply some AI tools to it, figure out ways to manage that infrastructure in a way that is more efficient than, kind of rolling a truck on a regular scheduled basis, which is maybe the alternative way in what you would have to do. And so, as you think about just kind of proliferation of edge assets and, how we need to actually manage those assets, well, Median was really the only pure play player doing this. And so I think we really liked we like to kind of call Median a snowflake around what they do. Sure, there are alternatives. Folks can build this in-house, folks can roll trucks. But to really kind of think about how do you do this efficiently at scale and allow developers or solar installer to focus on what they're good at, which is just, hey, go build the asset, go finance the asset.
Yep.
But most people, as an afterthought, to actually think about managing the asset. And so as you think about Median, it's tremendous tailwinds with just kind of what we think are happening with solar. It's an index play. It's not a single bet on specific technology or country. There's tariffs on China, there's tariffs on Korea. Median still benefits. It's embedded to the overall asset class, and the asset class has been it's trillions of dollars now. And so even if there is a cycle, even if new deployments in solar goes down, Median is still growing, because at the end of the day they are managing the cumulative installed base of assets. And so it's a really nice business model. And so I think when we looked at the business, we liked that it was attached to both resi and C&I. It's about 50-50 mix between those two. And so I think from here, it has really strong product market fit. It has really strong customers, with commercial customers, with residential customers that are deploying new assets. And I think for us, for Median today, it's, can this be truly a platform play? We just made an investment. Median just made an investment in a business in Australia. So starting to lay the seeds for a truly international platform. We're starting to expand into other products, starting with storage. We're looking at electric vehicles, potentially heat pumps at some point. So can we be multi-product, multi-asset class, we multi-country? And so I think I think this business, you can, kind of continue to build it and continue to scale it. And I think it'd be one of the truly, hopefully one of the, the pioneering solar clean tech businesses that can get created.
You and me both, my friend. What, in your opinion, is preventing wider spread adoption of solar and other sustainable tech in the built world? I mean, you mentioned Australia, and their, solar per household is, way, way dwarfs what we have in the US, and CC&I, like we mentioned, has been slow to uptake. What do you think? What is there a single barrier? Is it a few things playing at that? What do you think is going on in the U.S.?
Yeah, I mean, I think the biggest thing. I mean, the cost structure for distributed generation is it's too high.
Yeah.
It's roughly $3 a watt for distributed generation, maybe $2 for C&I, maybe $1 for utility. And if you look at Australia, it's like $1 for distributed. So and I don't know, I don't have the silver bullet, for solving that. We look at a lot of companies, but the actual panel, like if you think about if you think about the effects of tariffs on our industry, like these panels cost 20 cents. And so of the $3 cost, like very little is actually going for the panels. So even if you double the cost of panels from 20 cents to 40 cents, like it doesn't really do that much to the actual overall cost of the project. So, I think that's just a structural. I think there's, as important as these investment tax credits are, and I'm certainly, a fan, and, we'll see how the negotiations in Washington go around the Inflation Reduction Act. But I do think there's something around the financialization of what we've done with these TPO, third-party ownership models, where someone comes in and finances it. They raise something called tax equity, which is a way to monetize these investment tax credits. Then you get asset-backed leverage. It just adds to the complexity. And I think that certainly capital markets coming in supply some of that lubrication that expands the aperture of who can participate in clean energy, which is a good thing. But it does seem to have added like more costs or complexity that, compared to other regions. And so, there's that. I think there's, permitting reform, and, if you look at like Louisiana, where PosGen operates, it's, closer to $2, whereas in California, it's like closer to $4. And so like, I think there are certainly some states that have, just less red tape, which, I mean, these things are hard to change, but over time you'd hope that you kind of eliminate some of those things. But it's a lot of, we look at trying to find what we call internally and actively, we call them soft cost killers, ways to reduce customer acquisition costs, ways to reduce the actual installation costs. There's tools out there that are helping, like, how can we find better places to site these systems? How can we actually have a better data on, who was most likely to adopt? And so we're getting better with like intelligence and targeting and going after the right homes. But it's, if you look at just the data over the last 5-10 years, there hasn't been a huge, kind of cost downward inflection on the residential side as much as we've seen on the hardware side, where the cost of the actual panels has come down quite tremendously.
Based on your experience with both public and private investments, how does the market currently misprice sustainability risk or opportunity?
Yeah, it's a good question. It's interesting. One of my favorite metrics from my days on the public side is price to book value. So you look at a company's balance sheet and you look at the equity value that they have, and then you look at what the public markets are, pricing that equity. And so, if you kind of roll back some of these players like Sunrun and, Hannon Armstrong, Brookfield Renewables, I think there was a lot of excitement 2-3 years ago around what these companies were doing and the amount of capital it wasn't going to get needed to get deployed into these sectors. And so the price to book, really, was kind of took off. And so if you just map out price to book over the last 10 years, I think Hannon Armstrong peaked at like a 4 times price to book, and now it's come back kind of closer to kind of 1 times or 1-2 times. And so right now the capital markets, the public equity markets are certainly signaling to these players that there's a lot of overhang, that there isn't basically the franchise value, which is the spread between kind of book value or 1x book value and anything above that. Like there's not a huge amount of value that's being ascribed to the franchise value of these platforms that are being built. I think if you look at other parts of our economy, what's really interesting is if you look at a lot of these like electrical equipment providers. So if you look at like a Train, which is doing a lot of HVAC equipment, if you look at an Eaton, some of these players, like, and you map out that price to book, like you see the opposite. You actually see, Train now is at a 10x price to book, and a decade ago it was 2 times. And so you basically, and if you look at Quanta Services, a $45 billion company that's an infrastructure company, they're mostly equipment people like traditional valuation metrics on the public side would say, well, maybe that's worth a little bit more than one times book. Maybe it's 2 times the franchise value. Well, that's trading close to 6 times right now. And so there's a huge premium. And I think if you ask me why, like there is the capital markets is basically telling these companies to build. We need to build more. We need more transmission. We need, we need more electrification. And so there's kind of this like capacity. We just need more capacity in America. And so I think it's really cool to see that feedback loop between what capital markets is signaling. Then these corporate leaders, these CEOs, these boards are, seeing their stock prices and seeing, the incremental dollar that Train can invest in new book equity will result in a 10x increase in their stock price. Well, of course you would do that. So I think it gets really interesting signals from what capital markets and the public equity markets are actually, pretty good about these signals over the long term. One just on things on kind of mispricing. We invested in a company called Kin Insurance, which is doing home insurance for residential homes. And what they've done is they're targeting these catastrophic prone regions. So think like Florida with hurricanes, think Texas, think California now where they just expanded into with wildfires. And so the traditional way of kind of underwriting of being able to offer insurance is really around risk pooling. That's what a State Farm would do, or if you go to like Farmers in Iowa Insurance, or it's really about kind of like pooling risk between a bunch of people, and they're often set up as a co-op, these insurance companies. And so now when you have, the effects of climate change are kind of more readily being seen on our physical systems, you're starting to see one of the earliest indicators of where the mispricing is happening. And often it's the insurance companies. They're quite reactive, financial markets. And so, what you've seen in Florida is homeowners insurance has doubled, or basically doubled over the last 5 years. And, a lot of companies like, the big incumbent carriers have pulled out of that market, just being, really thrown off by the amount of damages, not being able to kind of fine tune their portfolios and, being able to kind of the fidelity around risk management. And so, it gives opportunities like Kin to go into those markets and still risk selection is highly important. But they have a direct to consumer model where they can go out and, really craft the portfolio that is still insulated or protected and make sure that they're getting kind of the right prices for the risk they're taking. And so I do think like this mispricing or, mispricing a risk, or just like people not fully appreciating the effects of climate change on our, these kind of buildings, these physical assets. We've at Activate been looking at kind of financial markets way to invest in either insurance companies or other providers that are more forward leaning or forward thinking on those.
Yeah, boy, if there was an industry that ever felt ripe for disruption, I think insurance would be near the top. Yeah. We're nearing the end here, Eric. So let's jump into some lightning round questions, just quick hit answers on a few topics. Solar, wind, geothermal, nuclear. Looking 5-10 years from now, what do you anticipate will be the fastest growing source of energy in America?
Oh, fastest growing. I think, maybe I'll say geothermal.
Yeah.
I love geothermal. We don't have an investment in geothermal. It's a small asset class today, but I do think some of these, taking some of these oil and gas fracking technologies and drilling technologies, then applying them to geothermal, it's clean base load. So I'm excited about what geothermal can offer.
Likewise. Name one investment that you've made in your career that has delightfully exceeded your expectations.
I think if we go back to the days of Value Act, we invested in a business called Trinity Railcar, which was just investing in, it was a rail car manufacturing and leasing business. One of the kind of the cool things about that investment was we basically were able to buy in for kind of the book value of the rail cars that they had in their lease portfolio. And then we got the manufacturing of rail car business effectively for free. And so, once the capital market kind of fully appreciated that aspect of the story, the stock ripped and we did quite well.
I didn't think we'd hear about rail cars today.
Rail cars.
Where do you think the renewable energy marketplace will net out in this current political climate?
I think it looks like the current, what came out of Washington with the first draft on the IRA actually wasn't as bad as a lot of people were thinking. I think the 25D, which is the tax credit for homeowners for solar, looks like that may not make it. which would actually be huge implications for the sector, which we don't have time to get into now. But I think these, at the end of the day, these technologies are in the money. There's capital there that will finance them. And the IRA seems to be, reasonably supportive of the industry over the next, 3, 4, 5 years. At the end of the day, the industry needs to stand on its own. And so, I think this transition period of the next 5 years, the industry needs to get more efficient to continue to, do what it's been doing.
You already mentioned geothermal, so I'm wondering where you're going to go here. But if you had risk-free capital to invest in one nascent idea that you really believe in, what would it be?
I like circular economy. I think, we've struggled with it at Activate to invest in it because you do take input and outputs risks. But there's a company I actually had in the office yesterday. It's called Graphitic Energy. And they're basically cracking natural gas and creating hydrogen and graphite as their end products. And so it's kind of like it's not quite circular economy, but it's the way that, to kind of fully use the molecule for two end products, where like traditionally you would just burn, through traditional pyrolysis to create hydrogen, you would just burn the natural gas and you'd have a bunch of CO2 and a bunch of, excess global warming. Here you're creating two end products. It's, bringing industrialization back to America. We just don't make enough of this graphite, which is critical for cathode or anode active material. And so if you look at a lot of these next generation, things that we need here in America to power the energy transition, like, trying to bring that back to the US, I think it's just super important. These are like critical infrastructure industries.
That's really cool. That's all the time we have for today. Eric, if folks want to learn more about you, the work you're doing at Activate Capital, where's the best place for them to go?
I was gonna say call me, but I'm, that might be tough. But find me on LinkedIn. Feel free to reach out. I love talking about this. People that want to nerd out about these things, happy to grab a coffee for those in San Francisco. And you can go to activatecap.com to find more about our fund and kind of our thesis, our portfolio companies, and happy to chat with anyone at any time.
Well, Eric, thank you again for joining us today on the future of CRE sustainability. For all those listening in, thank you, and I'll see you on the next episode.